My name is Frank Gooch, and I am Chairman of Pengana International Equities Limited, or PIA as it is known on the ASX. Thank you for joining the webinar this morning. The objective of the webinar is to provide you with further details of our recently released proposal to invest in global private credit and to address questions you may have regarding the proposal. Following my opening remarks, I will invite Nehemiah Richardson to discuss global private credit so that you might have a better understanding of the risks and benefits of the asset class. Nehemiah is the Managing Director and CEO of Pengana Credit, and he will be responsible for the implementation of the proposal. He will then be followed by Russell Pillemer to take you through the details of the proposal. Russell is PIA's Executive Director and the CEO of our manager, Pengana Capital Group. Now, I've been involved closely with the listed investment company sector for almost 30 years. I joined Milton Corporation in 1996 and served as its Chief Executive and Managing Director from 1999 until my retirement in 2018. I was appointed a non-executive independent director of PIA in 2017. I've witnessed significant changes in the LIC sector and collective investments more broadly. Milton itself grew from a $300 million company whose shares traded at large discounts in 1996 into a $3 billion company with its shares trading in a narrow range around its NTA in 2018. The LIC sector has grown substantially in terms of number of LICs as well as the total market capitalisation. Unfortunately, shares in many of the LICs now trade at discounts to net tangible assets. These include the traditional LICs that have a history of trading at par and premiums. There are very many views on the reasons for the discounts and how they can be addressed. At PIA, we noted that significant funds continue to be invested in financial products but that the LIC sector has not maintained its share. Passive vehicles such as ETFs have grown rapidly. With this in mind, we commenced a comprehensive review of PIA. We examined a wide range of approaches adopted across the sector and engaged directly with advisors, brokers, and shareholders. The feedback we received was strikingly consistent. Investors value the professionally managed global equity exposure and diversification that PIA provides, and they value the reliable, fully franked dividends. But they were also clear that they wanted stronger returns, and they were very focused on higher dividends, particularly in the context of the regulatory changes around bank hybrids. This feedback helped to focus our thinking. We concluded that PIA must adapt to market realities and innovate to enhance investor appeal. It should continue its mandate to invest in global businesses, but not just in the form of equities. It should also invest in the form of professionally credit. PIA would then have a unique offering that is not easily replicated by any ETF or other collective investment vehicle. The proposal has been designed to diversify PIA's global asset exposure, deliver increased reliable earnings and higher sustainable fully franked dividends, which should ultimately translate into a stronger shareholder experience and a narrower discount to the NTA. Once the new strategy is implemented, your directors will be targeting an annual dividend of 8.4 cents per share, fully franked. This is 56% higher than the current annual dividend. PIA is better positioned than most LICs to implement this proposal, as its manager, Pengana Capital Group, has the expertise to invest in investments in global equities as well as private credit. Additionally, the manager's relationships with international banks have enabled PIA to negotiate a very competitive debt facility. Now, it's important to note that this proposal is subject to shareholder approval at the upcoming AGM, and these changes can only be implemented with your support. I encourage you to use this webinar to better understand the proposal and ask questions should you have any concerns. Now, I'd like to just invite Nehemiah to present to the webcast, please.
Very pleased to be here with you all today. And I guess, reflecting on Frank's remarks regarding what investors are looking for. So professionally managed global exposure, diversification, reliable income. Well, that's actually what we deliver in global private credit. And so I think we can deliver these characteristics while also adding to PIA's portfolio resilience in an uncorrelated fashion. So it really is a perfect fit. Now, to many of you, global private credit might sound a bit technical or unfamiliar, but it's actually quite simple. Once you understand what it is, I think you'll find it's an attractive investment proposition given the defensive characteristics it can add to portfolios. So what is private credit? Well, in our definition, global private credit refers to professional investment managers that lend money directly to companies, usually US and European mid-sized businesses of around $1 billion or more that operate in safe and secure industries with the lending done at modest LVRs to help them make investments to grow their businesses. Now, these loans are typically held and managed closely by the manager until they're repaid in full. And because they're held to maturity, the managers don't just hope that things will work out. They must be confident from day one that the business that they lend to can repay them. And that makes them highly selective and very disciplined. Given the recent news about Australian private credit, you've seen in the press, it's important, I think, to differentiate the US and European private credit markets from the Australian market. And I think in particular in Australia, the majority of private credit is concentrated in commercial property lending. By contrast, in the US and Europe, large segments of the commercial lending market are serviced by private credit managers rather than banks. These loans are privately negotiated. They're made to high quality, stable businesses in non-cyclical industries like software, healthcare, infrastructure, or business services. And there are three things that make these loans different and underpin the attractiveness of global private credit. And they are, firstly, that they're predominantly senior in the capital structure, which means, and they have security rights. And what that means is the loans are backed by first rights to assets and cash flows of a company. And so they're first in line to get paid back. Secondly, they're held to maturity, so they're not traded on the bond market, which helps avoid daily price swings. And thirdly, they're carefully structured by experts with clear contracts, reporting obligations, and the ability for the manager to step in early if something goes off track. Okay, so go to the next slide. So why is global private credit in such high demand from investors? Well, because private credit is designed to provide stability, it's about earning steady income with much lower volatility than you would find in shares or bonds. Investors are not relying on the market going up. Our managers are lending money to a business and getting paid for it. So most of the return comes from interest payments, not capital gains. And those payments are contractual, meaning there's a legal obligation to pay interest and repay principal. In addition, these loans are typically floating rate, which means the income goes up as interest rates go up, and that's incredibly helpful during inflationary times. And it's an asset class that delivers reliable income, strong capital protections, and has a track record of holding up well in different market conditions, which provides useful diversification in investor portfolios. All characteristics which I think are additive to the PIA portfolio. So if we go to the next slide, so what about the risk? Well, we focus on segments of the global private credit market through our managers that historically has had very low default rates, very high recovery rates when defaults do happen. And this is because the managers do a significant amount of work up front, choosing quality borrowers, negotiating the right terms, and setting up early warning systems so they can act before problems escalate. These loans are not like listed corporate bonds or syndicated bank loans where risk is spread across thousands of investors and managers can intervene when things go wrong. In global private credit, the managers stay in close contact with the borrower. So, they're very involved, they're very informed, and they're very empowered to act. And remember that these managers only succeed when they get paid back in full, right? So the incentives are perfectly aligned with preserving investor capital. So another reason global private credit is such a powerful investment tool is that it behaves differently from shares and traditional bonds. Private credit does not follow the ups and downs of the share market or the bond market. It's not traded, so it's not subject to market panic or short-term sentiment. And this is what makes it such an excellent source of diversification, something that smooths out returns and reduces overall volatility in a portfolio. So as you can see in this chart on the right, over the past 10 years, global private credit's delivered higher returns than volatility, which is rare. And that tells you how efficient it is as an asset class. So what makes global private credit perform well? Go to the next slide. I've already mentioned the aligned incentives managers have and how they structure loans. There are several things I think that work together here. Firstly, you get an illiquidity premium in this asset class. Because the loans are not traded and the managers provide speed, flexibility, and certainty to borrowers, right? The borrowers will compensate them for locking up their capital over time. Secondly, there's a floating rate structure, which helps returns keep pace with interest rates. And then finally, and this is really critical, private credit is a space where manager skill really matters, right? It's not about buying an index. It's about finding the right deals, negotiating strong terms, and staying close to the borrower. And when done well, it's this combination that produces the attractive returns, the steady income, and the real resilience. The kind of qualities that long-term investors are increasingly looking for, as evidenced by the strong institutional demand that you actually see globally for the asset class. So go to the next slide. Well, none of this matters if it's not executed well. So we don't invest in one fund or one manager, right? Instead, we work with Mercer, being one of the world's most experienced private credit consultants, managers, and investors, to build a highly diversified portfolio, which today includes 24 top-tier managers and over 3,500 individual loans spanning multiple countries, sectors, and strategies. So this is a true institutional quality portfolio constructed to reduce risk, increase stability, and deliver reliable returns through different economic environments. And now I'll just say a quick word about how we approach our portfolio construction, because this is a space where the principles behind that construction really matter. The first priority is capital preservation, right? So that means every loan in the portfolio is selected and structured with a priority on managing downside protection. Secondly, active management. It's essential in a dynamic world. Thirdly, manager quality is everything, as I already spoke to. And finally, we believe in building resilient portfolios. So that is ones that can hold up through different market environments. And that's achieved by spreading risk across geographies, managers, strategies, industries, and individual borrowers. And it's really this thoughtful approach that gives us, and hopefully will give you, confidence that the portfolio is being managed with care, discipline, and very deep expertise. So to summarize, global private credit is about lending to mid-sized businesses through private senior secured loans. These loans are structured to protect capital, deliver reliable income and returns, and avoid market volatility. It's a space that rewards experience, discipline, and diversification. And with the right approach through a professionally managed, high-quality, multi-manager portfolio, offers excellent long-term benefits for investors. So thank you for attention. I'll now hand over to Russell.
Over the next 10 minutes, I will walk through the key elements of the proposal. So let's kick off with the basic mechanics of the proposal, explaining how it all works. This is actually pretty simple, as it essentially only involves two key elements. So firstly, PIA raises funds by taking out a loan from a major global bank at a very low interest cost. Secondly, PIA takes this money and invests it in a high-yielding global private credit portfolio. The difference between the return on the credit portfolio and the cost of the loan will be profit for PIA shareholders. The slide on the screen shows a very simplistic illustration of the mathematics of the proposal. So in this illustration, PIA has $200 of net assets and takes out a loan of $100. The cost of the loan is 5%, and so the yearly interest cost is $5. The proceeds of the loan are invested in the credit portfolio, which earns 9.5% per annum, which equates to $9.50. So PIA is generating income of $9.50 against expenses of $5, and this results in a $4.50 of additional profit for shareholders. This is equal to, this $4.50 is equal to 2.25% of the net asset value, which is a very meaningful uplift in profit, and this enables us to pay additional dividends. This is an illustration of what PIA looks like after the implementation of the proposal, with the new elements shown in grey. It is important to note that the credit portfolio will be totally funded by debt, and so it will have zero impact on the amount PIA invests into global equities. Shareholders' exposure to global equities will not change in any way. However, they will also gain an interest in global private credit. Blending global private credit and global equities really makes a lot of sense. The credit portfolio is designed to be a low volatile and low risk exposure that generates consistent and reliable income, as Nehemiah explained earlier. Importantly, this portfolio should have very low correlation with listed equities, meaning that the value of the credit portfolio should be stable irrespective of rises and falls in equity markets. So combining global private credit with global listed equities should result in PIA having a more balanced portfolio, blending equity growth with consistent, reliable income. As a closed-end ASX listed investment company that is invested in large and mega cap global companies, PIA has some distinct advantages that are not available to other vehicles such as unlisted unit trusts and ETFs. These advantages include the ability to efficiently raise debt in USD at very competitive prices, the opportunity to invest in illiquid private credit, and the possibility of being able to distribute a steady stream of fully franked dividends. On the funding side, PIA has been able to source US denominated debt at a very competitive rate. In today's terms, this would be the equivalent of borrowing at less than 4.5% if we were borrowing in Australian dollars. Now, those of you who have got or who have tried to get margin loans on equities, this cost is likely to be around the 7.5% mark. So by taking out the loan, PIA is essentially taking advantage of a highly valuable inherent benefit. Also, specifically for SMSF investors, there's an additional benefit. Due to regulations, SMSFs cannot easily or cheaply borrow to invest in shares, which is quite unfair, as investors who have savings outside of super in family trusts or family office structures absolutely have the ability to borrow against their equity portfolios, and many do. So by having debt within PIA, the playing field is now leveled for SMSF investors, enabling them to indirectly borrow cheaply against their equity portfolios. PCG, together with Mercer, will be responsible for delivering the credit portfolio. PCG will not charge any fees for the management of the portfolio in order to maximize the chances of the credit portfolio earning its target return, which is equal to the cost of the bank loan plus 4.5%. So in today's environment, that's equal to about 9%. PCG has entered into an agreement whereby it will receive returns in excess of the target return, so in excess of that 9%, and will cover PIA for the cost of the interest on the bank loan to the extent that it is less than the return of the credit portfolio. So PCG is really putting its money where its mouth is to give investors comfort. We are unaware of any other fund manager in Australia that has agreed to provide such a level of downside protection to investors. This should provide shareholders with significant comfort regarding the downside that might be in the proposal. Importantly, PIA provides a unique and highly differentiated source of yield for investors. Most Australian investors receive equity income exposure through their high-yielding ASX-listed dividend stocks, which are highly exposed to a small number of industries, including financials, materials, energy, and real estate. PIA's equity portfolio is totally differentiated from these industries, generating yield via the disciplined realization of capital gains in its global equities portfolio from time to time. PIA will now also generate yield from its credit portfolio, which has no correlations with listed equities. Many Australian investors also generate yield from investing in assets whose returns are correlated with movement in base interest rates. Examples of this include property, bonds, and hybrids. PIA's yield is different from all of those strategies in that it is totally uncorrelated with movements in base rates. So investors who are worried about the impact that reduced interest rates will have on their investment portfolios might find PIA to be particularly attractive. In summary, we think the proposal adds significant value to shareholders. It takes advantage of cheap debt to diversify into high-quality global private credit and should result in a substantial earnings uplift as well as a 56% increase in dividends. In addition, PIA's differentiated profile adds to its usefulness in portfolio construction as its dividends are derived from sources that are unrelated to ASX equities and its yield uncorrelated with interest rates. That ends my part of the presentation, and I will now pass over to Paula for Q&A.
Thanks, Ross. We've had a fantastic level of engagement, and as you can imagine, with so many attendees, there's been a wide range of questions. To make the most of our time, I'll be grouping the questions into key themes so that we can address as many as possible. The first one is for you, Ross. This proposal sounds compelling, but why hasn't any other LIC done something like this?
Yes, so that is correct. No other LIC has borrowed cheaply and then use those borrowings to invest in global private credit. But I would say that this type of strategy would be quite commonplace at the higher end of the market, where super high net worth individuals or family offices recognize that there is an opportunity to borrow to invest in high yielding assets, including private credit. So that's done quite frequently. And closer to home, PIA has also taken inspiration from our largest shareholder, Soul Patts, who indirectly do exactly what we are accomplishing in the proposal. So Soul Patts have raised debt really cheaply, and Soul Patts has built up a really large portfolio of private credit. I think it's more than $1.2 billion today. So that's a great example of how some really sophisticated investors have used this type of initiative.
Yeah, Russ, if you don't mind, I'd also just like to add that it's very difficult to access highly diversified quality institutional global private credit. It's a problem that most can't do. So, PCG can provide this access through Pengana Credit, and that I think makes it very difficult for any other LIC to copy or do what we are doing.
Thanks, Frank. This one might be for you, Frank. What are the risks compared to the current strategy?
Right. Paul, under the current strategy, the company is fully invested in equities. The returns to investors are based on movements in the market valuations of our investments. Under the proposed strategy, the company will continue to be exposed to that same value of equities. However, they will represent roughly 2/3 of the assets. In addition, the company will have an investment in a diversified, low volatility global private credit fund, which has historically low default rates. So the additional income under this strategy will largely be reliable interest income. The debt facility that will fund the additional investment will be in US dollars, and most of the credit facilities are also in US dollars. So we have a reasonably natural hedge. And the facility is at very competitive rates, which maybe many other LICs may not be able to achieve. It has been structured to minimise any risk of the security being called, and so that's another offsetting issue. To further lower PIA's risk, though, PCG has agreed to guarantee that cost of funding. So in fact, we see the combination of global private credit with the existing equity portfolio actually adds true diversification and lowers the overall risk to the company.
Thanks, Frank. We might stay with you again. What level of confidence is there that PIA will be able to provide continuing fully franked dividends for, say, the next 3 years under current Australian laws?
Thanks again, Paula. At the end of June 25, so in our financial statements recently released, I think we said there that we have sufficient franking credits to pay a dividend of about 15.5 cents, franked at 25% rate. This, based on the current annual dividend of 5.4 cents per share, that would fund a dividend, fully franked dividend for the next 2.5 years, or a little bit over that. I think following the implementation of this proposal, we are targeting an annual fully franked dividend of 8.4 cents. So, that's 55%, 56% higher. But our analysis indicates that with the tax paid on the income from the private credit investments, and without paying any more tax on our equities, we could sustain a higher dividend through until about September 27.
Thanks, Frank. The next one for you again. Who drove this process? Was it PCG or the independents on the board? How can we ensure that the right governance is going to be was followed?
Yeah, sure. Look, about the end of last year, I initiated a review of PIA to try and identify what steps we could take to help reduce that discount to NTA at which the shares trade. So we worked with PCG executives. The board considered options to make PIA unique so that it was no longer competing directly with ETFs and could provide a higher level of dividends. It was through this process that it became apparent that this could only be achieved through the addition of another asset class to the asset mix. So then when we looked at what asset classes we could add, we came up with the global private credit, which PCG does have expertise in. So at that stage, we asked PCG to put together a proposal, and the two independent directors, Sandy Olio and myself, we were then responsible for negotiating the terms with PCG. I should also mention, Paula, that we're as part of the shareholder approval process, we will be getting an independent experts report to opine on whether it's fair and reasonable. And this will be presented to shareholders with the notice of meeting for the annual general meeting, and shareholders will have to where shareholders will actually consider the proposal.
Okay, thank you, Frank. Harding Loevner has underperformed the benchmark over 1, 3, and 5 years. Why have they underperformed, and what do you intend to replace them? Russ, do you want to take this one?
Sure, I will. Look, the underperformance of Harding Loevner is absolutely disappointing for shareholders and for everyone involved in PIA. The key reason for the underperformance is the investment style that Harding Loevner uses, which is called a quality growth style. And this really results in a conservative portfolio that has excluded companies that trade on very high multiples. Because of this style, Harding Loevner has been very much underweight the large NASDAQ stocks that have really driven the market over the last few years, such as Nvidia. That would be the key example. So Harding Loevner does have a 35-year track record of outperformance, but they get most of this outperformance during periods where the market is going downwards or sideways. And this style of investing really does suit PIA, as we're trying to ensure lower volatility, which will always also lead to more stable dividends. So whilst we are disappointed that quality growth hasn't worked over the last few years, I think and the board thinks that this is the right style for PIA over time.
Okay, thanks, Russ. Frank, this one might be for you. What are the risks of a margin call? Frank, I think you're on mute.
Sorry about that. Look, I think the risks are actually quite low. In structuring the facility, we tried to mitigate the risk by ensuring there was plenty of headroom with the facility limits, and it would then need quite a significant market disruption for any call to occur. We've also put in place drawdown limits that are well below the total facility limit. In addition, the private credit investment guidelines that we've outlaid to Pengana Credit require the manager to maintain a level of liquidity in the portfolio that will protect us against a call.
Okay, thanks, Frank. Nehemiah, I found one for you. I'm a very satisfied investor in PCX, which I bought at the IPO, and it trades at a nice premium to NAV. Will the PIA credit portfolio be the same as the PCX portfolio? And should I hold both in vehicles in my portfolio?
Yeah. Well, firstly, I'm really pleased that you're a happy investor, so thank you for that. So look, don't know what your personal circumstances are, so I'm not really in a position to give any personal advice, but what I can say is that both will hold very similar credit exposures and have similar gross distribution yields. I think with PIA, PIA is very differentiated in that it also provides investors with, exposure to equities or global equities. So, subject to your personal circumstances, I personally think that, there's ample reason to own both in a portfolio if it can work for you.
Okay, thank you. One more for you, Nehemiah. I have read recently about many Australian private credit funds that are in trouble with bad loans. Why is this any different?
Well, I think they're just very different markets. Okay. And so what you find in the Australian private credit sector is, predominantly, or the majority of private credit in Australia is in the commercial property sector. And as I spoke about earlier, what you have in US and European markets is very mature markets with, managers that have been through many dynamic cycles who invest in a senior secured basis with defensive companies where they have, information rights and plenty of security and very close management. So I think, just very different sort of beasts. And I would not be reflecting what you see in the press on Australian private credit, to the US or European markets for those reasons.
Okay, thanks. Frank, I might pass this one to you. What is happening with the Wilson strategic value notices? Why they're looking to replace the board? Do they plan to appoint WAM as the fund manager?
Yeah, thanks, Paula. Look, we have received notices from WAM Strategic Value that are seeking to nominate four directors for the election, and to remove three of the four current directors from the board. The directors they are seeking to remove include Sandy Orleo, who's an independent director, and Russell Pillemer and David Groves, who are both directors of PCG. At this stage, we've not been provided with any information as to why they want to remove or add the directors. Similarly, we have no info as to what their plans are at this stage if they were to be successful. So, we've written to WAM Strategic, and we've asked a series of important questions so that we can understand what they're proposing. But at this stage, we haven't yet received a response. I do note, though, that WAM Strategic would be unable to change the investment manager at PCG, as PCG still has over 4 years remaining on its contract. While WAM Strategic is part of the WAM Group that directly competes with PIA and PCG, it would seem that there would be some conflicts of interest if they were successful. On this basis, to me, at least, it appears that the proposal is practically unworkable and hard to see how it could be in the interests of shareholders.
Okay, thank you, Frank. In the days following the announcement, the share price went up steadily, but it has subsequently declined. Do you have any explanation for this? Russ, do you want to take this one?
Yeah, I'll take that. So yes, it did go up, and we were really encouraged in those days immediately following the announcement to see that rise. We could see some real momentum building to closing the discount to NAV. So why has it subsequently declined? I guess there are several factors that have impacted the share price, including that PIA has gone ex-div, and also the broader markets have softened. However, it seems pretty clear to us that really the key impact has come from the comments made by WAM Strategic and its chairman in the press that harshly criticised the proposal. And we saw this with further falls after WAM Strategic announced that it would seek to overthrow the PIA board, with the obvious implication being that the proposal might not proceed. And so, I think then, that had a further impact on the share price. But based upon the early support that we witnessed in the share price together, but before that involvement from WAM, together with the overwhelming positive response we've continued to receive from shareholders, we are confident that should the proposal be passed at the AGM, PIA will be strongly positioned to regain their positive momentum and hopefully, ultimately close that discount to NAV.
Okay. Thanks, Russ. We've had some great questions today, and thank you again to everyone that contributed. Unfortunately, we've gone over time a little bit, so if we didn't get to your question, we'll get back to you directly. To close the session, I'll hand back to our chair, Frank Gooch, for some final remarks.
Yeah, thanks, Paula. I hope you can agree with me that the proposal, or at least the webinar, has provided plenty of information about the proposal, and I think you need to understand that it's been very carefully developed and to date well received by advisors and many shareholders. We believe that the benefits of the proposal will include a unique diversified exposure to global businesses. It'll increase reliable earnings, and that should lead to higher fully franked dividends, which will be paid monthly to shareholders. PIA will be attractive to a higher number of investors, which should ultimately lead to the narrowing of that discount. So I urge you to provide your support by casting your vote at the upcoming AGM. Now, thanks again for attending this webinar and submitting your questions, and I wish you well for the day. Thank you.